Many thanks to Maria Assunta Alvin for including the paper in the program. It's an honor to be here, an absolutely fantastic event. So let's see how. Okay, so I'm going to be talking about the trade war of 2018, 2019, and its impact on the financial sector. So the paper is titled Trade Uncertainty and Bank Lending. We're going to focus on the case of US banks. And the trade uncertainty episode we look at is largely generated by what happened in the public discourse and trade policies during that time. The paper is joined with Linda Goldberg, Julian Di Giovanni, and Ricardo Correa. They're all affiliated with the Fed, so the usual disclaimer applies. So obviously to this audience, I do not need to motivate the paper. We worry about uncertainty, not only because of the way in which the corporate sector reacts, and therefore impacts on the real economy, direct impacts on the real economy, but uncertainty is also very deleterious. It's very impactful on the financial sector's decisions. And we have pretty much, I think there's consensus that we have entered an era of higher uncertainty than before. As we have seen from Nick's presentation yesterday, the last few decades have seen, according to some indicators, increasing uncertainty. In particular, since the GFC, we have Brexit, the pandemic, geopolitical events, and weather events, all of which have increased the average level of uncertainty. So in the paper, we focus on trade uncertainty related to signs of deglobalization, signs of a slowdown in trade activities across borders, and issues related to fragmentation, reshoring, nearshoring, all sorts of disruptions to the general patterns of trade we had seen historically. We know uncertainty changes investment in ways that are very clear theoretically from the corporate finance literature. We know a little bit less about how it impacts the financial sector, and here we'll be talking in particular about banks. As seen from this chart, which simply shows trade risk or uncertainty aggregated from firm-level data as a simple average over time for publicly listed firms. This is an indicator from the Hassan et al. Work. So this is based largely on text analysis of earnings call transcripts. If we look at trade risk over the past 10 years or so, we see a spike around 2017. So this is a time when there are many trade-related discussions between the US and China that did not result in any actionable items. They were sort of without any result before the imposition of tariffs, largely retaliatory tariffs, in 2018 and 2019. And so this trade risk indicator shows a spike that is quite remarkable, 3.6 standard deviation increase relative to the long-term average. At the same time, I'm not going to spend time showing, sentiment does not deteriorate much. So it looks like it's the distribution of outcomes associated with trade policies around this time that becomes wider and harder to assign probabilities to different known states of the world. Interestingly, other types of uncertainty also increase, but in a more muted way. And of course, everything we're going to be saying here about trade uncertainty's impact on the financial sector, will be very careful about controlling or making sure that those effects don't pick up increases in other types of uncertainty, sectoral, environmental, health-related, etc. So the crux of our analysis will be to focus on this period, post-trade war, if you will. It's more like a pre-during trade war. 2 years before, 2 years after, our entire methodology will be a very simple diff in diff that will examine banks' lending decisions vis-a-vis domestic US firms for banks with differential exposure to the trade war, and in particular, the trade uncertainty generated by it. One final note on this, again, in this particular episode, trade uncertainty is largely generated by trade policies. But this need not be the case with other uncertainty episodes. So the motivation is that the financial sector is largely left out of general equilibrium analysis of the impact of trade wars on the macroeconomy. And we think that the financial sector should not be ignored because it has the potential to amplify contractionary impulses from the real sector. In particular, we think that there may be different mechanisms by which this may occur. For instance, banks, just like non-financial firms, may adopt a wait-and-see attitude consistent with real options theory, by which they may just want to postpone lending decisions or adjust the terms of lending in ways that make the lending more reversible. And I'm going to be very precise about what that means. Secondly, there may be mechanisms related to financing constraints. Banks that are ex-ante more constrained may be a little bit more stricter and tougher about the lending decisions, or careful, cautious about the lending decisions that they make, because ex-ante constraints translate into future constraints. And so they may be worried about future balance sheet losses, all of which would constrain them even more. And if they fund themselves in public debt markets, as they often do, then they may be worried about cost of funds responding to that. So we are also motivated by looking at survey data for US banks from the Federal Reserve Senior Loan Officer Opinion Survey. In April 2019, the Fed deployed the survey it's the regular credit monitoring survey, but they added a number of special questions, just as the trade war was ramping up. And the questions asked the banks, if you're, first, are you exposed to international developments regarding Asian and European firms? And second, if you are concerned, how are you mitigating, how are you thinking about your potential responses to protect your balance sheets? And what banks said is very insightful. So this is not many observations. We're only surveying about 80 banks here. But interestingly, 40% of them said, yes, we are worried, and we are tightening credit standards to firms exposed to these international trade developments. Of course, we couldn't ask explicitly about the trade war, right? This is a Federal Reserve survey, and actually the purpose of the survey is to inform monetary policy making. So the language was not very precise. Nevertheless, this is so insightful to see that banks kind of figured out what we were talking about. And they also said that they would increase collateral requirements, restructure loans, use covenants to mitigate credit line drawdowns, and increase loan loss reserves in anticipation of future losses. So what the paper does is to basically bring a lot of very rich data to quantify all of these different responses and to understand how banks responded to the trade uncertainty generated by the trade war. So in brief, we're going to do the following. First, by way of research design, we're going to exploit exogenous quote-unquote increases in trade uncertainty. I hope I'm not antagonizing the identification purists in the audience by using this word. I'm using it very loosely, just to boast, but take it with a word of caution. I'm going to exploit this largely unanticipated increase in trade uncertainty and combine very, very granular data on trade uncertainty, again, at the firm level from Tarek Hassan's and co-authors' work with banks' initial sectoral loan shares. I'm going to lag those sectoral loan shares quite a bit to make them as predetermined vis-a-vis the sample period, and obtain bank-level measures of exposure to trade uncertainty. And then we're going to relate those bank-level measures of exposure to trade uncertainty to banks' lending decisions. And we're going to look at the number of extensive and intensive margin adjustments in lending. We're going to ask, how do these banks react to trade uncertainty? Which borrowers are affected? Is it only the high uncertainty borrowers, or are there spillovers to low uncertainty sectors? Is there evidence of effects on real outcomes of firms? And then we're going to bring more data to pin down the two mechanisms I alluded to before, a wait-and-see mechanism whereby banks behave just like Pindic-Dixit firms that prefer to withhold lumpy and irreversible investment while waiting for uncertainty to resolve. We're going to see that loan maturities extend and banks they start downgrading their firms and their borrowers. And finally, we'll pin down financial frictions channel by exploiting heterogeneous balance sheet constraints of banks. So we rely on the US Credit Registry, which is the Y14 data. I'm sure many of you are very familiar with this data by now. The data is the closest we can get to a credit registry in the US. We're not spoiled like in Europe, especially in Scandinavian countries where there are all these beautiful credit registries matched with persons and with businesses. Here we have a slice, but a significant slice of bank credit, covering about 75% of total loan commitments, loan level data, and covering also about 60% of non-financial business debt. So importantly, we have both public firms and private firms matched with bank balance sheets. And the critical ingredient to the analysis is the bank level exposure to trade uncertainty, which we construct from firm level trade uncertainty measures coming from Tarek Hassan's research program. So let me give you a sense of which sectors were subject to large increases or decreases in trade uncertainty. So you may remember that most of the trade tariffs that were imposed affected the agricultural manufacturing sectors. And so that's sort of consistent with what we obtain here. So what do we do here? What do I rank here? I rank the sectors as a function of the increase in trade uncertainty, or the change between 2016-17 and 2018-19. So some sectors saw an increase, some sectors saw a decrease in trade uncertainty. The ones that saw an increase are typically manufacturing and freight transportation sectors, consistent with the sectors we know received tariffs. The ones that received a decrease or saw a decrease in trade uncertainty are the ones mostly in services. We're going to split these sectors into two groups, high and low uncertainty firms. The high uncertainty sectors are going to be the sectors that generate the shock. And the low uncertainty ones, the ones below the 75th percentile, are the spillover firms, if you will, the ones that are not the original source of the shock. Key for our identification will be that as we examine lending vis-a-vis these firms, we want to make sure that they are on parallel trends before the trade war in terms of performance. We want to make sure that the high uncertainty ones were not underperforming the other ones. This may be a concern for sectors like retail that have seen a secular trend towards lower growth and decline. And when we look at that, we see parallel trends. So the bank exposure to trade uncertainty, our key ingredient for the analysis, is a continuous measure that takes the change in trade uncertainty at the sector level, I had just plotted on the previous slide, and weighs it by the bank's initial loan shares from the credit registry lagged vis-a-vis the trade war to 2014-15. So the bank exposure measure should be, in principle, a bank level variable. We're going to exogenize it a little bit more by computing it by leaving one sector out. So then we transform it into a bank sector level variable. This is a bit of a trick that you basically you take out the data for every individual sector at a time in order not to look at the lending to that sector as a function of the bank's exposure to that same very sector. Just a little identification trick. And this is following the method in Federico et al.'s paper. It's a beautiful paper, RNR-DAR, that inspired a lot of our work, that looks at the impact of China's WTO accession on Italian banks and firms. So lo and behold, this bank exposure measure is quite uncorrelated with standard bank characteristics. This is not to say that our treatment of banks is exogenous. It's just somewhat reassuring we're not capturing some intrinsic bank characteristics like liability structure or size. So let me walk you through a number of conjectures, the associated specifications, and the results. The first conjecture is that banks respond to increased trade uncertainty by reducing credit supply. We're going to test this conjecture by relating a number of lending outcomes to the bank exposure interacted with the post-dummy for the trade war period, 2018-19. Remember, the pre-period is 2016-17, so we have quarterly data over these 4 years. So very, very standard diff in diff. And then, of course, the standard set of bank controls in levels and interacted with post. And then we're going to have pretty demanding fixed effects. Those in the empirical banking literature are very familiar with them. These are the Quajamian fixed effects that hold time-varying quarter-level firm demand for credit fixed. And we also have firm bank fixed effects to control maybe for assortative matching between banks and firms. Or firm-level demand that loads on bank characteristics, which may occur if banks are specialized in providing certain types of credit. So the results, basically the baseline results, are here. What we see is that in the post-period, during the trade war, banks that were more exposed to trade uncertainty ex ante reduce loan growth vis-a-vis their borrowers, not only vis-a-vis all firms, but also low uncertainty firms. So all firms is high and low uncertainty together, and this is just a spillover effect. Of course, I could have shown this just as high and low, but we thought it's more interesting to kind of isolate the low uncertainty firms. And interestingly, the same effect, the same supply side effect also is reflected in loan spreads. We see that the same more exposed banks charge higher spreads. So this is important for two reasons. The fact that we find loan spreads going up speaks to a loan supply effect, and similarly, low uncertainty firms are the ones that are probably receiving the smallest demand shock. So it's good to kind of isolate them and see very similar effects. So we see banks pull back from risk-taking in the face of uncertainty. Now I'm going to pull back from these results and say that, as you look at uncertainty, I mean, in my lifetime, as I was working in policy, I saw how banks react to, I guess, the mother of all uncertainty shocks, which was the COVID pandemic. Some may argue it was an ambiguity shock, like a Nietzschean uncertainty type shock, because not only we didn't know what probabilities to assign to different states of the world, but we could not even imagine some states of the world. Are we going to end up being healthy and okay, or total zombie apocalypse? We didn't know. So how banks reacted at that time was very insightful. They pulled back from risk-taking, they tightened lending standards to levels not seen since the global financial crisis, despite being very well capitalized and liquid. And that behavior is very consistent, again, with how non-financial firms behave. They just postpone investment. They don't want to deploy very precious capital during a total shutdown of the economy, until and unless they can see what the recovery rates on that capital is and what the rate of return is. Okay, so this is the baseline. I have dynamic effects, placebo, anticipation effects, the whole 9 yards for a diff in diff. And let me also then show results for the extensive margin of lending, where again more exposed banks show a lower probability of renewing offering new loans, both in loan level data and in bank firm aggregated level data. So on the intensive and extensive side, or margins of adjustment, we see evidence consistent with banks pulling back from risk-taking in kind of an indiscriminate way, very similar to what happened during the COVID pandemic. So the second conjecture is that, consistent with real options theory, the first mechanism that I articulated earlier, of non-financial firms making investment decisions under uncertainty, exposed banks will adopt a wait-and-see attitude. And how can we tease that in the data? Obviously, bank loans are different from from investments in, say, building a factory. So we need to kind of think, how would banks wait and see? How would they adopt? How would that be reflected in how they write loan contracts? And so we think of three ways of testing this, which we interpret as consistent with wait and see. One is that banks are more likely to downgrade the creditworthiness of their firms. So they think, everybody's riskier now. I don't know what states of the world will happen. I don't know what probabilities to assign to them. It's hard for me ex ante to pick winners and losers. It was very difficult to know which sectors are going to win from the trade wars, which ones are going to lose. And overall, now exposed, we know there was more pain than gain really associated with the trade war. But ex ante, it was very difficult to pick those winners and choosers. So downgrade everybody and then see who can weather the trade war. Secondly, I'm going to reduce, as a bank, I'm more likely to reduce loan maturities. Ideally, if I were a banker, I would only offer demand loans, meaning loans that are callable on a short notice, what we call demandable or on-demand loans. Of course, on-demand loans that are very much preferred by bankers for a number of reasons, that it gives them so much flexibility to call the money back on short notice, are not that frequent in practice. About 15% of loans we see in the credit registry are demand loans. But even when I write a loan maturity in the contract, which is preferred by most borrowers, I will prefer to make that loan shorter maturity so I can assess the firm more frequently and change the terms of lending depending on how that firm's creditworthiness evolves. And finally, if I am in a more uncertain world, I will try to reduce exposures to riskier firms. In the context of trade wars, those would be firms that are less protected by tariffs. That's something I can observe as a banker, or that are likely to incur higher input costs, maybe because they're more dependent on intermediate imports in the economy. The second conjecture relates to the financial constraints channel. This is much more straightforward. It says that simply lower capital banks that are more leveraged and therefore likely to incur a higher increase in the cost cost of funding, the external finance premium for banks, should contract lending more. We're going to proxy for these future financial constraints with current ones because they're sticky over time, and you know, test our hypothesis this way. Perfect. So I'm going to run you through a couple of tables that test these two channels. For the wait-and-see channel, the first piece of evidence concerns loan maturities. Indeed, we see that more exposed banks increase the share of short maturity loans, loans with a maturity of less than 2 years. Average maturity is 5 for the typical bank loan, credit line or term loan in the US credit registry. And at the same time, they increase the share of these demand loans. So overall, like I said, 15% of all loans are demand loans. Demand loans have no specified maturity. They enable the banker to call up the firm, call the money back. If the firm cannot pay, it's a bit of a problem. Then there's litigation involved. And banks will do everything they can to avoid two things: costs of litigation and default by the borrower. So there will be a lot of discussions here and a lot of negotiations before they go to court. But the bank basically can call back demand loans. And we see a higher share of them in a highly uncertain environment. Secondly, also consistent with the wait-and-see channel, we see that exposed banks assess higher default risk for firms, as reflected in the probability of default, which is a forward-looking indicator of a firm's default risk, and which is computed or calculated by the bank itself according to its own risk, internal risk model, broadly in line with the Basel II framework. Finally, still consistent with the wait-and-see channel, we see that banks cut lending relatively more to low-tariff protection firms in manufacturing sectors where the import tariff revenue relative to consumption is lower, so they receive lower tariff protection. It's below median as opposed to other ones. So we see lower loan growth and higher prices, more on the margin actually. No difference in loan prices, but lower loan growth for low tariff protection firms. And the final way we cut the data is to split the firms in high and low import dependence. The idea here is that if you're in a high import dependence sector, you are more likely to see an increase in the cost of imported intermediate inputs and in the cost of production as these tariffs are being put in place. Again, we see higher contraction of credit and more expensive loans vis-a-vis such firms. When it comes to financial frictions, two capital measures, just for robustness. One is the simple leverage ratio, and the other one is the stress test capital ratio, which is the amount of capital you would be left with in the worst state of the world, the severely adverse stress test scenario. And a lot of people think of that as the true level of capital for a bank, the one that would be they would be left with should Armageddon ensue. And we see that low capital banks have stronger responses consistent with the financial frictions channel. So did all of this credit contraction, which I have established admittedly in differential effects, did it have differential impacts on firms dependent on banks? To assess the real economic effects, I'm going to construct a firm exposure measure that is simply a weighted average of the bank's exposure for those lenders that lend to every single firm, weighted by the importance of those lenders in the firm's total debt. And when we do that, we see that firms more exposed to banks that are more exposed to trade uncertainty are the ones suffering relatively more. They have lower total debt growth, investment spending growth, and asset growth compared to other firms. And because I'm running out of time, I will just say that these results are a lot stronger for firms that are more dependent on banks. And firms are more dependent on banks than we generally think in the US. I mean, private firms or firms that have a lot of debt from large banks in their overall debt exhibit much stronger effects. To wrap up, I'm gonna skip over the economic magnitudes. They're not staggering, but they're not too small either, just the right level for the story to be believable. And a whole battery of robustness checks. I do want to mention that we pay attention to ruling out some alternative explanations. A lot of stuff is happening during this time. These are good times before the pandemic. The US dollar is appreciating, so we take care of some exchange rate channel that may affect our results. We have a horse race with bank exposure to tariff hit sectors. Our baseline measure survives, so both uncertainty and exposure to policies matter. And finally, a horse race with bank exposure to overall uncertainty. Overall uncertainty, so across all sectors, does not affect our baseline effect. So basically, our effects are consistent with the trade war generating this endogenous tightening in the financial sector. So basically, the paper makes 2 points. First, that there's a banking channel for the transmission of uncertainty shocks to the real economy, perhaps novel. And that second, the implications is that analysis of trade wars macro impacts should account for this endogenous contraction of the banking sector through the financial sector that come on top of the contractionary impulses from the policies themselves. This is a layer, a financial sector driven layer of contraction that should be accounted for in these models. Perhaps it's not very large, but it should nevertheless, it's important and it's there. Thank you.
And our discussant is Andrea Polo from Louise.
So thank you very much for the invitation. I enjoyed the format a lot. I learned a lot yesterday and today, so thank you very much. So there is a growing literature on these economic consequences of trade war, okay? What does this paper add is that, these trade uncertainties / trade war, I'll come back to this, has an impact also on financial intermediation. And if it has an impact on financial intermediation, we want to know whether these reinforce and amplify the economic consequences, okay? So let me step back and say, let's look at the literature. So there is a literature on trade and banking. Okay, so the traditional literature is, there is a shock on banks, and you want to see what happened to trade. Okay, so there's a financial crisis, some banks are associated to some firms which are exporters, so the fact that the banks suffer, do now the exporters suffer because of this, okay? This paper belongs to the other way around. That is, there is a shock on trade, doesn't matter for banks. And on this we have less, and the literature is very recent, so what we know is there is some evidence on trade liberalization, so on the other way around. So there is this paper that she mentioned by Veronica Rappaporte and Discussant on Italy. So they exploit when China entered into the WTO, whether this matter for the way banks lend in Italy. Actually, there is a kind of similar paper on Spain, already published on the JFQA. But so there is this debate. And now, unfortunately, in the last few years, we had the different problems. So the problem were the other. So the concern were the other way around. Whereas there was a series of adverse shocks to globalization, and the International Research Banking Network started to initiate a project where different country teams organizing different studies around the world exploiting this different deglobalization shock. And this paper goes under the umbrella of this, let's say, this big project of the International Research Banking Network. They exploit different episodes. So Russia invasion of Ukraine in 2014, Brexit referendum on German banks, retaliatory trade restriction from China to Norwegian banks. And in the words of Claudia Buch and Linda Goldberg, who are the head of the directors of this program, they say these papers are people that people are writing these days, okay? But they say we're already starting to learn a lesson. What is the lesson? When there is a deglobalization shock, this impact on financial intermediation. The financial intermediation means that this has an impact not only on the affected firms, but also on the non-affected, and this has some sort of real effects. Okay. Now, this paper, so it's a diff on one of the largest deglobalization shock relatively to the other episodes we have seen on the most important country in terms, we want to know what happened in the US, and use these excellent data, because you cannot go better than this data in the US. So what is the bank? So it's a diff. So the shock is 2008, so post 2018-19, pre 2016-17. And what is the bank heterogeneity? Some banks are exposed more to sectors which are characterized by high uncertainty before the shock. What are the results? So affected banks cut credit supply, this is not just to the borrowers which are affected, but to all borrowers, so there are spillover. Firms associated to these banks suffer, so they are not able to substitute real effects, and then these two channels that she mentioned. Okay, let me start with my comments. So let me go with an overall assessment. So, first of all, we want to know what is the answer, right? The globalization shock matter for financial intermediation. Does this amplify economic concept? It is a very big question for finance and for international economics. So, as I said, it's the biggest shock about all these events of the last few years. Excellent data, and the paper is already robust. Okay, so the paper has been already presented several times. Very good discussants. I'm sure they gave very good suggestions. I have a little experience of this because since this week I was on holiday. When I was sent the paper 2 months ago, I read it. Now, the version that I got while I was on holiday was a completely different one. And where all the things that I already taught, because I couldn't do work during these days, were already addressed. So basically, for a banking economist learning about trades, there is a big question of bank specialization, because the tools that we have, they don't work if there is bank specialization. They do everything they can do. So they add control for specialization dummies, add dimension of loan type, fixed effects, because you are concerned that maybe in trade finance. So this was the original approach already taken by Guachemian in the 2008 paper. They focus on subsample non-affected firms for which these issues are less present. They distinguish between trade uncertainty, overall uncertainty. They also consider this exchange rate, because exchange rate moved during this period. Okay, so there are placebo tests. Okay, so they tick all the boxes that you can think of. So let me go with let me start with my comments. Let me start with the quibble. That is, the post-dummy starts 2018 Q1. November 2016, the man entered into the White House. This was an unexpected, somewhat unexpected event. Now, he immediately acted, which, by the way, is true for also other presidential elections, no? Also Democrats, so immediately act on this thing. But and you see that there is a start already, when he's elected. Now they already are aware of this. They say, okay, let me drop 2017 from the pre-sample, but then the most obvious thing is that then why not the post be in 2017, 2019, okay? So this is a small quibble. Let me go on the variable. So trade uncertainty variable. So this variable is based on this evidence from text-based analysis in earning calls by Hassan et al. For listed firms, okay? So two questions arise. Which companies declare more trade uncertainty? Because these are, in earning calls, these guys say, well, I think we don't know what's going to happen with trade. They look for this type of expression, okay? So which are these companies? Second, can you go from listed firms to private sector? So from listed firms to private firms in the same sector. Can you do this extension? So it would be useful to bring more economics to this variable and further evidence. Why I had a concern when I was reading this? Because we learned from Nick Bloom that trade policy concern indeed became a major source of US stock market volatility. So he has a paper now, look at various episodes of stock market volatility, and you find that in many of these episodes, there is indeed trade concerns behind these shocks. But actually, if you ask companies, are you concerned about these issues? Results are very modest. Okay? So did you change your capex because of this? Results are modest. So what is going on? How can we reconcile? So Davis in a blog says, well, I think what is going on is that listed firms and private firms are very different. So listed firms have significant commercial interest abroad, foreign production facilities, the export in the US, chains run through China, brand distribution network, which is tied to foreign economies. So can you do, so it's not clear that whether non-listed firms in the same sector may have the same concerns, and 90% of the firms in the sample are private. Second, which are these companies? So in theory, which companies are affected by this trade war? So exporters, because they're afraid that now they cannot export. Non-exporters who are afraid from competition from importers, that maybe this competition is not going to be there anymore. and firms that they use intermediate inputs. Okay. Now, the good news for the paper is that this validation has been done. So there is a comment published on the Journal of Monetary Economics on the variable of Dario. So there is a Caldara et al. Variable which is very similar to this one, same spirit. So trade, firm level, uncertainty based on earnings calls, okay? And this guy kind of validate this measure exactly around these two concerns that I had. That is, okay, let me find sectors of these three type of firms, like exporters, non-importers, and importers of intermediate input, and let me see whether this measure is correlated with the listed firms that I get from this Caldara et al. And as you see, it is very much correlated. Okay, so these two concerns that I had, thanks to this, they seems to be addressed. Actually, I think this is very important because it tells you why you need to use this variable instead of using this variable that I thought that if you want to verify this, why don't you check whether this is true for sectors with imposed tariffs? No, because the uncertainty goes for all these three type of companies, and that variable is exactly the one which is able to capture them. So the other thing you can do with this is that you can check this whether either as a robustness one of these three sectors or which of these three is more important for your variable. Now, the other concern that I had is it's a bit a concern in general with the uncertainty. Are you capturing first moment or second moment of the distribution? No? And of course, during a war, during a crisis, first moment, second moment are very highly correlated. When price goes down, relatively increase. So my prior was, well, if really they want to have a paper on uncertainty, they should stop in 2018. That is the moment where finally uncertainty is revealed because tariffs are imposed. Actually, no, this is not the case. So they were right. The reason is that there is a huge uncertainty on the level and on the sectors. So this is why you cannot use imposed tariff sectors as a variable. So it would be useful to document this. So document the timeline of the events. March 2018, first tariffs are imposed. China retaliates. The US increased the number of sectors, increased the size. European intervene. So this is why there is this tit for tat, which stops in 2019 when there was this agreement with China. No? So in fact, Dario, in this presentation shows this is the implemented tariffs, this is under consideration. This is why it's uncertainty and it's not sector. So I think that these type of arguments are really useful to justify what they're doing. I was skeptical before reading it because I had this concern, but actually, in fact, I think that both the variable and focusing on uncertainty is exactly the right approach. So let me go on the channels. So the first channel is lower capitalized banks exposed to trade uncertainty, contract lending by more. So this makes perfect sense. Risk in portfolio go up, loan loss provision go up, or net worth of banks go down, okay? Now, can the authors provide any direct evidence of that? So did loan loss provision increase? In the post period, is there any evidence these loans that you give to these high uncertain firms indeed perform worse? If there is no evidence, it's possible because the sample is short, no? Because there is 2020, which is the COVID. So maybe are banks acting in expectation of future capital losses that did not materialize yet? I think this is we need to have other evidence or discussion of this thing. So the other channel is exposed banks adopt a wait-and-see attitude, reducing maturity of loans, then gradually exporting firms. So this one I find less convincing. I find less convincing because is this a different channel? When company says tighten credit standards, so maturity is one of the credit standards. So it's a multifaceted contract, credit. If you want to tighten the standard, you reduce quantity, increase price, ask for more collateral, reduce maturity. So in a sense, it's not similar. Second, there is this evidence on the PD, which I find unclear. That is, they say, well, so after this happened, the affected banks, they look at their firms and they increase the PD they attribute to all their firms. Why? So in a sense, these PD are based on internal models. Think that they are like Z-score, that you put these internal models are validated by supervisors. So how do you change why some banks change, how do they change them? I mean, if you want to take less risk, you just don't lend to this guy. But why you change the PD of all your firms? And you can say, well, maybe they do it ad hoc. But ad hoc is pretty complicated. I think there is a big debate in climate risk that you don't know, should they increase the PD? But the thing is that it should be on a model. We don't have the model, so it should be ad hoc. And it's difficult to do it. And so this stuff is not obvious. And in fact, this is not in the action list that they presented. Actually, in the action list, there is a debate on covenants, on hedging. I think if they can bring evidence on these, this could be useful. Okay. So there are small things. So only 2.4% of loans are trade finance. This seems a bit small. So how are they defined in this registry? Now, bank and trade uncertainty is 2014, 2015, but specialization 2017. So these are small things that I think that small incoherence that can be fixed easily. So bottom line, I think the paper will be useful to document. So there are very strong arguments out there why they're doing what they're doing, and I think it will be useful to put them in the paper for the reader. On the channels, they probably can do a bit more to clarify, bring more evidence, or clarify whether two mechanisms are not just one. And so bottom line, I think there is important results with a clear contribution. No? The question is so important, with a clear contribution in international economics, finance, and the paper is already super robust.
Camelia, would you like to take a moment to respond? And I think after that, we have time for one question from the audience.
Absolutely. Thank you so much, Andrea. This is a fantastic discussion. I really like your suggestion to maybe start the trade war period with 2017. 2017 is when some of the trade talks started and resulted in no agreement. So that's exactly the first uncertainty shock. We see the first spike happen at that time. Does Wall Street reflect Main Street? So do these public firms transcripts say anything about private firms, the extent to which private firms face uncertainty? I think that's a great question. And there's a literature there on how much listed firms reflect developments in the broader real sector. I mean, they surely account for a large share of employment and value added, but I think we can do a bit more there. Great suggestions on documenting the timeline of events a bit more carefully, and maybe working a bit more on the financial frictions channel. And I think we're gonna maybe think a bit more about the wait and see channel. You weren't very convinced of how we interpreted those findings, so we'll give them some thought. Thank you.
Any questions from the audience? Yeah.
So just a suggestion on the wait and see, it looks more like the banks want to keep flexibility. So it doesn't seem that they're waiting. They're just doing something, but they're finding a way of getting out of it. So I don't know. I just felt like it's not that they're just not doing anything. I would have expected when you said wait and see, it's like, okay, we're kind of freezing everything, see what happens, and then we decide to make more loans. But it seems more like it's the opposite. It's just they enter into more flexible contracts. So maybe if you can show a little bit more evidence of that, if they issue some credit lines, what are the terms for those? If they're issuing less credit lines, I know that the Y14 gives you a lot of data on that.
Yeah, that's a great suggestion. So all of the results I showed were for credit lines and term loans together. Credit lines are about 2/3 to 3/4 of all loans. So there's some evidence of wait and see in the sense that they do lower the acceptance rate on, they're less likely to give completely new loans. So the share of new loans declines for more exposed banks, and for existing loans that they renew them at lower terms. So like lower volumes, for instance. So that's a way to just like reduce exposures to these riskier assets. But that's also a very good interpretation of. They also try to increase flexibility on existing loan contracts. Agreed.
Given we're sort of a little short on time, let me go ahead and move to the next paper on the session, and feel free to continue this discussion over coffee.